Over the last several years, Bian Ximing quietly built one of the most profitable gold trades in modern history. Reports suggest that he made roughly $3 billion riding the gold rally, not by chasing headlines, not by reacting to short-term noise, but by understanding the structural forces that were setting the stage for gold long before the crowd caught on. And what makes this story important isn't the number, it's the timing. Because Bian's trade wasn't about guessing tops or bottoms. It was about recognizing when the global financial system was shifting in ways that made gold inevitable. To understand how this happened, you have to zoom out. To understand how this happened, you have to zoom out. Gold doesn't move like a tech stock. It doesn't rally because of earnings growth or innovation. Gold moves when confidence breaks down, when trust in currencies weakens, when debt grows faster than the ability to service it, when central banks quietly admit that stability comes at the cost of purchasing power. For years, gold was written off as a relic, something that didn't yield, something that didn't belong in a modern portfolio. But while that narrative dominated financial media, central banks were doing the opposite. They were accumulating gold at one of the fastest paces in history. That divergence mattered. Bian Ximing understood that gold isn't just a commodity, it's a monetary asset. And when monetary systems come under strain, gold doesn't need permission to reprice. It simply does. In the years leading up to gold's breakout, we saw a perfect storm forming. Global debt levels surged. Governments normalized deficits that would have been considered emergencies a decade earlier. Central banks locked themselves into policies they couldn't easily unwind. Interest rates stayed artificially low for too long, and when inflation finally appeared, it wasn't temporary. That's when gold's role began to change again. For institutional traders like Bian, this wasn't about inflation headlines. It was about real rates. When inflation rises faster than interest rates, the real return on cash and bonds turns negative. And historically, that's when gold thrives. At the same time, geopolitical risk was rising. Supply chains were fracturing. Sanctions were being weaponized. Countries began to question whether holding reserves in someone else's currency was actually safe. And quietly, central banks across Asia, the Middle East, and Eastern Europe started shifting reserves into gold. That wasn't a coincidence. Bian Ximing reportedly positioned heavily into gold as these trends accelerated, not just through paper exposure, but through long-term conviction that the monetary system itself was becoming more unstable. And as the rally unfolded, that conviction paid off. But here's the key point. Gold's move wasn't explosive. It was methodical. It climbed through resistance levels that had capped it for years. It held gains during pullbacks. It attracted buying not just from speculators, but from institutions that normally ignore gold entirely. That kind of price action tells you something. It tells you that gold wasn't being chased, it was being accumulated. And when a market moves higher on accumulation instead of euphoria, it usually means the story isn't finished. The $3 billion Bian Ximing reportedly made wasn't luck. It was the result of understanding that the rules of the game were changing, that governments were trapped, that debt could only be managed one way, and that currency debasement, whether admitted or not, was the path of least resistance. Gold doesn't need growth. It needs imbalance. And today, imbalance is everywhere. Governments are running deficits even in times of economic expansion. Central banks are stuck choosing between financial stability and currency stability. Banking systems are under pressure from unrealized losses. Bond markets are fragile. And trust, once lost, is very difficult to restore. That's the environment where gold stops being ignored. What's also important is who is buying gold now. It's not just retail investors, it's not just hedge funds, it's sovereign buyers, institutions with long time horizons, players who aren't looking for a quick trade, but for protection against systemic risk. That's why stories like Bian Ximing's matter, not because everyone can replicate the trade, but because they reveal how serious capital thinks about risk. Smart money doesn't wait for confirmation. It positions early, quietly, and patiently. And when the narrative finally shifts, the trade is already crowded, but only for those who arrived late. Gold's rally has forced many to reconsider assumptions they held for years. That inflation was transitory, that central banks could normalize policy without consequences, that debt didn't matter as long as markets believed it didn't. Those assumptions are being tested now, and gold's price is responding accordingly. What's interesting is that despite the rally, gold still isn't universally loved. Many portfolios remain underallocated. Many investors still view it as insurance rather than opportunity. That tells you something about where we might be in the cycle. Historically, gold tops don't happen quietly. They happen with enthusiasm, with mainstream endorsement, with headlines declaring a new era. We're not there. Instead, we're seeing steady accumulation, central bank buying, and strategic positioning from traders who understand macro risk. That's exactly how the early stages of major gold moves tend to look. Bian Ximing's success wasn't about predicting chaos. It was about recognizing fragility, about understanding that when systems rely on confidence, anything that erodes that confidence has outsized impact. Gold doesn't promise returns. It reflects reality. And the reality right now is that the global financial system is more leveraged, more interconnected, and more sensitive to shocks than at any point in modern history. That doesn't mean collapse is imminent. It means optionality matters. It means protection matters. It means assets that exist outside the credit system regain relevance. Gold fits that role. The $3 billion earned riding this rally isn't just a personal win, it's a case study in how macro awareness translates into positioning, in how patience beats prediction, and in how markets move long before consensus catches up. Whether gold continues higher or consolidates, the forces that drove this move haven't disappeared. Debt hasn't gone away. Inflation hasn't been fully defeated. Central banks haven't regained flexibility. Those pressures remain, and as long as they do, gold remains part of the conversation. Not as a trade of the week, but as a reflection of the system itself. That's the lesson behind this story. Not that one trader made billions, but that the conditions which made it possible are still very much in place.